include health tech, IoT, and insights, connected consumer, connected home, as well as agriculture technology. My focus personally is primarily on the health tech and ag tech side of things. In terms of very quick background on me, started my career as an economist, made a transition to working in investment banking and M&A, did that for a number of years, have had some stints as an entrepreneur, as well as working in corporate business development for Hootsuite, a startup here based in Vancouver. And in terms of the, just transitioning a little bit to the impact of COVID-19 on, really, I think from a portfolio company perspective, we're really seeing companies sort of across the board are recutting the numbers as kind of step one. So what are, given the high degree of uncertainty that exists right now, how do we recast some more downside scenarios and ensure that we have the capital we need to weather the storm and get to a place where we think we'll be able to raise money again? So for the most part, VCs seem to be recommending, in the range of ensuring that you have sort of 18, 24 months runway. So given the downside now, what do you think is needed in terms of capital to get there, and how are you going to get it? And most people are looking first to their existing set of investors. In terms of thinking about our next investments and where we're going to deploy our capital, there's definitely going to be a focus for us first to address our portfolio companies. So we want to make sure that the companies that we've invested in have the capital they need to get through to the next round. So that's priority one. And in terms of new investments, for us being a strategic investor, it just means that really the barrier for how strategic it is to TELUS has been raised. So I'd say that applies to anyone who's looking at raising capital from a strategic investor like a corporation. You're going to have to be tight on why it truly is strategic, and you're really just competing for attention. A company like TELUS has 10,000 fires to put out right now, so why should we be focusing on what to TELUS is a relatively small amount of money, and putting some attention on that particular investment. And in terms of getting, thinking through, if you are looking to raise capital, how to get ready to prep for your discussions with investors for your upcoming financing. I think, again, speaking from the sort of corporate venture lens, they're going to want to hear what you've done to react to COVID. It's going to be a priority number one. If you don't have anything to say on that front, it's going to be a major red flag, because everyone's got to react to this new reality. So how have you reacted? What are the opportunities and threats? Why are you raising capital right now? And what is that going to let you achieve in this new environment? And again, on the corporate venture side of things, make sure you can make the strong argument for why there's relevance to on the commercial opportunity front to the strategic investor you're talking to.
Yeah, okay, you can talk to me later, okay?
So, Jeanette, I think you're on mute. Oh, there you go.
Yeah, if someone hasn't muted their phone, please mute. That would be great. Okay.
So that's it for me, Jeanette. If you wanted to pass it on to the next one, unless there's other things you need me to say.
Yeah, that'd be great. We'll pass it over to Keith, and then we'll come back for Q&A. I just want to make sure everyone's muting properly. Keith, over to you.
Hey, yeah, thanks. Thanks for having me, Jeanette, and thanks to Foresight for putting this on. 92 people online, so it's fantastic. So just to give everybody a quick bit of background, if I use the same agenda, so Spring is an organization that helps entrepreneurs to change the world, and so we tend to focus at the intersection of impact and tech. So that means primarily things like clean tech, health tech, progressive food and ag tech, impact marketplace, and e-com. Those tend to be the places that we do a fair amount of work. as it relates to let's call it the intersection of investors and entrepreneurs. We run funding roundtables in support of entrepreneurs to help them raise money. We also run an Impact Investor Challenge, which is actually a challenge-based program to help groups of investors to invest into selected companies. And our next cohort of that is actually kicking off next month. And so we'll have two versions of that. One will be for people who are established investors, and then the second one will be for people who are emerging investors. And so, so those would be a couple things to keep an eye out for as it relates to spring. Yeah, excited to continue to help deploying capital in the next coming months. Impacts of COVID-19. It is important to note that with COVID-19, it's, you know, there's COVID-19 and then there's the recession, right? COVID-19 will pass. The recession is going to linger. It's going to remain. And so the really important part is that, in effect, this is kind of like a camel hump crisis, right? There's like two humps to this process. One is the initial kind of lockdown with COVID-19. And then the second one will be the recession itself, which is absolutely global in nature. And so the impacts, of course, is that all businesses need to figure out how to, you know, lock down expenses, you know, kind of, and then reboot their plan, which includes rebooting sales, marketing, distribution, channel, team plans. And so that's a really, really important place. As it relates to investors and the impact of COVID-19, a lot of investors, you know, that are, let's call it traditional tech investors are, and as they do in past recessions, are standing on the sidelines waiting for some certainty to come back into the marketplace. Some have been impacted negatively by what's already happened in the public markets. And some, of course, are going to go deal hunting and might even become a bit predatory, which is a very, very small subset of investors, but it's just good to know it's out there. Another couple of impacts of COVID-19 for those who have seen the pictures of the Himalayan mountains from India. So, you know, people are actually like, this is one of those situations where you can tangibly see the impact on the environment by having people stay home. And so what we're seeing is impact investors kind of leaning in on certain impact investments, especially clean tech. And so I think that that's an interesting, at least moment in time. For requirements for next investments for us, a couple of key sectors would be food, health, and clean tech. Those would be the three core categories. Very similar to what was shared by Jay, looking for people who have been able to really focus in adapting to the new normal. We are looking for the two-part adaptation. One is COVID-19, but then second is how you're thinking beyond COVID-19 and into the recession, and how you will be able to show progress in light of all of this and in spite of all of this, I think is really important. And then the last thing that I would share on getting investment ready or getting investor ready as a company, one is show progress, like create your roadmap. How are you going to create progress in spite of this COVID-19 crisis, in spite of the recession? How are you adapting? What non-dilutive sources of capital are you taking advantage of? And then the last piece is you need to now more than ever relentlessly focus on who your ideal investor is. I would not waste time talking to investors who generically invest in software or generically invest in tech. You will be, now is, you waste your time. So if you're clean tech, be relentless on clean tech. And don't waste your time with other people, because now is not the time to kind of make an open call.
Great. Thank you, Keith. Last but not least, Tom.
And thank you, Foresight, for having me. So I'm a partner at Active Impact Investments. We're an impact venture capital firm. We were founded about 2 years ago. Mike Winterfield is the founder, and he and I are the two partners at this stage. And We've been deploying capital for a couple of years now. We have $10 million of assets under management in our first fund. And so most of our investments are seed stage investments. Initially, we any of the United Nations SDGs would qualify for this fund. And we've made 8 investments so far. We're very close to our 9th, which should be announced shortly. Really though now, as we move along, we're starting to focus in a lot more on GHG emission reduction, environmental sustainability as areas we want to make our last few investments funded. We should make probably 6 more in this fund.
Advertisement to buy that thing.
With the cats. We would then look to.
Hi, sorry, Tom.
Sure,
I've tried. I have attempted to mute everyone, and it seems that a few folks are not complying. And when I look through the list, everyone looks to be muted. So I don't know if there's a bit of a glitch. Tom, I apologize. Okay. No. Let's see here. There we go.
That's okay.
Tom, back to you. My apologies.
That's okay. I could have kids or animals come in behind me at any moment. So we'll see what happens. So first fund, $10 million, 8 investments made, about to make the 9th. The remaining investments will focus more on GHG emissions and environmental sustainability to fill it out. Our second fund that we hope to raise next year sometime will be very focused on those areas. The sectors that we tend to invest in, software as a service, sort of lower capital intensive technology, services businesses. These are things where within our group there's extensive experience as operators, particularly my partner Mike Winterfield, and post-investment support is a very important component for us, and those are areas that he's excels at being able to do that. Our initial check is $250,000. We save about $750,000 for follow-on investment. As far as the current times with COVID, and I definitely echo what Keith is saying. It's kind of a 2-part issue. It's COVID and then the recession that will linger afterwards. What we're seeing now is we're just spending a lot more time with our existing portfolio of companies. Some of them are, having to pivot. So for example, one company, GoJava, which is a green office solution company, saw its business dramatically decrease. It's now pivoted to home grocery delivery for the time being and recovered almost all of the lost office business. So that kind of thing. But sort of more generically, things that Jay was mentioning, helping make sure there's enough cash runway to get to the next raise. That can involve a number of things. That can involve how to deal with staff and difficult issues there, accessing government programs, whether it be the 75% wage subsidy that's come out now, or the 10% if you don't qualify for that, or the $40,000 loan under SEBA, helping companies work through what they qualify for and making sure they access what they can. Mm-hmm. And then in terms of next investments for us, going forward, it's really business as usual. We still have capital to deploy. We're still looking for companies the same as we were before. A little bit different perhaps in criteria. You're going to be more interested now in a company that is less exposed to the impacts of COVID. One company in our portfolio, Inkblot, is a mental health online mental health services. So, it's actually performing better in this environment. Others that are performing worse. So as we look at new companies, just thinking about which ones are better positioned to get through this, which companies are going to raise enough to ensure they have that runway that Jay mentioned. 18 to 24 months is great. And also just, I guess the other changes, naturally there's going to be, valuations are going to have to change just based on what expectations are of what the company is going to be able to accomplish. So I think those are the main issues we're looking at.
No, that's great. That's great. So it is 12:19. We have about 10 minutes to sort of banter back and forth on a few topics. A couple of the things that you've all highlighted on is, you know, the potential that that you might be looking for, not a better deal, but valuations will be, you know, sort of more critically evaluated moving ahead. Jay and Tom and Keith, can you comment on that? Is that something that you'll take a more serious look at, and how can companies best prepare to sort of prove their valuations?
Yeah, I mean, I can take a first crack at it. I think, you know, that's the pressure that will come on valuations will be part of the reason for why people will initially turn to their existing investors if you already have capital in the business today. So, you know, the people are focusing on their portfolios and keeping their stars going. And if you are one of those companies, you're a star in someone's portfolio, you're likely to get more traction and better terms from an existing investor who already understands your story and wants to see you succeed. If you're, you know, if you don't have a you know, strong base of existing investors, and you're out, or you just need new investors to come into the round to raise the capital that you need, I think, you know, the dynamics have shifted somewhat in terms of providing more bargaining power to those with capital. So that might have some changes on the margin, especially with regards to terms beyond just the valuation itself. But I think it's really about, you know, the value proposition that you're driving. You know, what are you going to be able to deliver? Make it clear the opportunity that you have before you and why you're the one that's going to succeed in your market. A lot of things, you know, don't change relative to how you would have pursued your capital raising previously. It's just that you're going to have to fight, you know, harder to make the case for, you know, a valuation that you might have expected to get 2 months ago.
Tom?
Yeah, I would say you know, this is where the runway issue comes in as well. Like, depending on when you're going to raise, that's an important factor. So, you know, if you thought you were going to have to raise in X number of months, and it's a small number, you want to do everything in your power right now to try to extend that out until times are a little better. Because, I mean, it's just you know, one of the things that investors are always going to look at the point in time when they're investing is what are the expectations in terms of revenue. That's one of the factors that goes into determining a valuation. So you're going to be a lot better off if the time when that's happening is at a time where you're a lot more able to say, well, look, we've managed to weather the storm. We were very capital efficient, and now we're, you know, back close to where you can see that we're right back on the track we were before. So for existing companies, I think that's the key. It's trying to be really capital efficient at this time, not to have to raise sort of right at the beginning of this, but when maybe people have settled down in terms of worrying and there's less uncertainty going forward in terms of being able to see how and when we might get back closer to normal.
Keith, do you have any comments before I move on to the next question?
Just a very quick one, which is just in hearing what you guys heard from Tom and Jay, just remember that the adaptation and progress is really whatever progress you're able to make. Tom's example of his one portfolio company getting right back up to the same revenue line, those are going to be critical in helping you be successful in fundraising. And I would agree with Tom that we're looking to build the case for when there's greater uncertainty, if it's possible to wait that long.
Yeah. For some of the newer entrepreneurs on the line, I think a lot of them might not realize that going through these ups and downs, though this is, I would say, unprecedented, is not abnormal for clean tech. When we look at 2008, or when, at the time that I happened to have been raising money for one of my companies as well, the investors really looked to see how you responded. Did you keep your head up? Did you stay focused? Did you, as you mentioned, Tom, just make sure you were capital efficient and really focusing on, it's these times where you really have to focus on what are the minimum things I need to do to be successful and get those few things done, as opposed to a little bit of what they used to call it for me is the shiny object, or the the distractions, right? So everyone really needs to be hyper focused, and I think that can go a long way. I have a question around the recovery packages. So as most of you know, Foresight has been quite bullish on collecting as much data as possible on everything from jobs and revenue and investments. And we're being, asked to share that information with different groups at the government level as well as industry level. And, there is a potential for, recovery support. As investors, will you wait for some of those indicators to make investment decisions? Or have you seen some specific sectors that you think will be more of a focus for you, given sort of what sectors are on hold, quote unquote, right now?
So I'll just kick it off. So at Spring, three levels: Spring, Keith Ippel, and then also our Impact Challenge, active now. And the reason is because I think there's some really, really good companies out there showing dramatic shifts and really stepping into opportunities. I think we all wish we had bought Zoom stock a couple months ago. And so when we look at things like mobile health, clean tech environment, there's some great companies that are actually at a better valuation now than they will be in 6 months when they've actually proven it. And I think the second piece is because I am an impact investor, and our Impact Challenge is about impact and therefore aligned with clean tech, is we see it strategically as an opportunity to invest now in companies that are actively making the world a better place, so that we can actually show people how to reshape the future of business, which is both economically amazing, but also is great for the planet. So for us, we're kind of, all systems go. Yeah.
Tom, any comments? Or Jay, I know you've got a few minutes left before you have to take off to another session.
I would just say, we're not going to base our investment decisions on waiting for any, regulatory changes to come up. We're going to keep, we may narrow our focus to a tighter range of companies that we feel are very highly aligned with some of our strategic objectives on the corporate front. But beyond that, the regulatory side of things is going to change how the lens through which we, decide if we're going to invest or not.
Mm-hmm.
Yeah, and for us, I think, from the time we start thinking about a company to the time we make the investment is often, it's not going to be less than a month. It's probably closer to 2 months. And so starting from today, by the time we're making that investment, they're either going to have got whatever assistance is available or they're not. And so, sure, it goes into the hopper, what assistance is available to them. Has the founder thought about that? Has the founder done what they need to do to access it? Do they understand, what's available and has accessed it? But it's probably not going to play much of a role, as Jay said, in what we're investing in.
And one more question before we close off here. A few questions here on the flood of cheap oil supply, drop in demand at a macro investment level. Do you think, what are your views on the prospects for renewables and the low carbon clean energy space given this dynamic? Tom?
Sure, pick on me first. I don't know that, I don't know if I'm an expert to predict that, but what I would say is, I think lots of people don't always appreciate what a long-term change it's going to be, right? I don't think that oil price shocks or are going to overnight result in renewables spiking one way or the other. It's such a long transition period in a country, especially like Canada, where there's so much political difficulty in bringing about the change. So I think I don't think it's a huge change. I think it's kind of business as usual, where we continue to move and push towards renewables, and over time renewables will become larger and larger. And as people start to realize, hey, like the cost, particularly once the cost of storage comes down, and people realize that renewable energy is getting cheaper and cheaper, and their storage solutions getting cheaper and cheaper. And it seems like we're spending a lot of taxpayer money subsidizing the oil industry. Over time, it'll happen, but I'm not sure that current oil prices are going to cause any quick, dramatic change in things.
Maybe I'll jump in with some comments, and I have to drop off. So I'll also say thank you, Jeanette, for having me. But an opinion from probably the least informed person on this call with regards to the clean tech space was not my core area of focus. But what I would see as an opportunity here is just, given that the world has changed and governments around the world are focused on how they're going to implement stimulus programs to get their economies going. And I do see that as a big opportunity for the clean sector generally, because hopefully governments will use this as an opportunity to write in requirements for sustainability objectives, et cetera, that may create great opportunities for startups in this space to take advantage of. So something to think about. So my thoughts, and thanks a lot, everyone.
Thanks, Jay.
Great to have joined. Cheers.
Awesome. Okay, it is 12:30. Keith or Tom, do you have any final? There's a few other questions here. Maybe we can keep that to the end. There's a bit of a presentation that I'm going to give for the next part of the session here. Any final thoughts, Keith and Tom?
I'll just quickly, nothing specific. I think we can, if we have time to answer some of these questions on the side at the end, that'd be great. I'll continue to engage in chat as well.
Tom?
Yeah, nothing else I can add right now. Thanks.
Great. So, I mean, again, one of the main reasons we want to start this dialogue is, on the one hand, it's so that everyone on the call, if you're running a business, you can be realistic about what you can expect in the coming months. On the flip side, it's nice to see that there's hope, right? There is still dollars moving and investments are being made. And the better you can manage your response to this, as devastating as it is, the higher the probability you'll be able to come out and be in a better position than others to raise the capital you need to continue moving ahead. A couple of key points I just wanted to summarize from our great guests here is, it is going to move from a health crisis to an economic crisis to a recovery situation. And the faster that we can move that along, the better. But obviously we can't do much until we see the doors open from the health crisis perspective. I think there's been a sentiment that there's going to be some leaning in on clean tech. I know, Keith, you've highlighted that, and Tom, that's your bailiwick as well. But it's important that you are able to show how you've managed the situation and progress coming out the other side. Focus your conversations on people that will be interested in you now or in the future. And make sure that you're up to date on the leverage that you can provide. There's been a lot of questions here on the BDC matching program for VCs, and we'll do a little bit of a snapshot on that later on in the presentation. But it's definitely something ongoing. And I think our guests next week from Breakthrough Energy and Cycle will have some additional comments on that as well. And if Tom and Keith, you want to jump in and comment when they're on the line, that'd be great. And the last thing is, capital efficiency. Thank you. Lots of great notes. Keep the chat going. The next thing I'm going to do is jump into, as you know, Foresight led a Pan-Canada survey on the impacts that COVID-19 has had on the sector. I think everyone on the call here is a strong believer that clean tech has the potential to be a huge economy for our country. Not only adoption within our country, but as an export to many other countries that are looking for technologies and innovations. So when we did the survey, we had about 200 folks respond. So all clean tech CEOs, and for us, clean tech remains to be broad. So clean tech is ag tech, industrial efficiency, bioeconomy, energy, transportation, and built environment, natural resources, just to name a few. So clean tech has become, is it a sector? Is it an industry? We always banter about this, but it's everywhere, right? Everyone's trying to do things better, smarter, faster. In terms of the size of the companies, about 59% are between 5 and 50 employees. And we are continuing to digest this information, and we'll be preparing a more formal report. So we might make it a little bit more granular to see, okay, 5 to 20, 20 to 50, because each of those companies' needs are a little bit different. But 33% were under 5 employees, and then we had 7% which were 50 or more. So somewhat representative of the natural sort of trend from ideation, and then as you filter through, you know, you get to commercialization and scale up. In terms of the counts of the company at different stage growth, you can see here early revenue 31%, mature 3.5%, growth 27%, and then as usual sort of a little under 50% pre-revenue. And we need that. We need to see that people are working on things, and they might not be in revenue yet, but what we're hearing from a lot of the survey results, or even the one-on-one conversations that all of us who participated in the survey are having, is a lot of them are just right at that crossing the chasm moment where they're about to commercialize, and then of course COVID-19 hits, and you have to take a step back and figure out, you know, your path forward. The sectors were broad. We don't need to go into too much of this, but the usual suspects: oil and gas, forestry, agriculture, manufacturing, construction. But where it really gets, you know, the reality check comes into play. And again, this information will be shared with the different levels of government at the municipal, provincial, and federal levels. But of the 200 respondents, the total projected revenue was about 1 billion. The median of that is 2 million, with the average about 6.3 million. So pretty strong numbers for companies. The updated forecast, unfortunately, is that there's been about a 65% reduction in projected revenues, down to about 442 million. The median reduced to 838,000, and the average cut in half, over half, to 3 million. So those are updated projections. Now, those could get worse or could get better as we see every week and month how all the different systems that all of us operate in are responding. Government, industry, investment, etc. In terms of jobs, the start of the fiscal year, about 3,517 jobs, with the average around 18. In terms of layoffs to date, we've seen about 991 folks laid off. Now, some folks have actually laid off prior to seeing some of these recovery packages. So we're hopeful that some of the wage subsidies, should you apply, which we'll talk about in a minute, maybe you can rehire, or the work share program, maybe you can rehire. And the average layoff is about 6 employees so far. And then there's an additional number planned, you know, 704, median to average 4. One of the things we've talked a lot about on the last couple of sessions is that, you know, talent in this sector is very hard to find. You know, your team, especially in the earlier stages, is so instrumental. So to have to let go of a researcher or someone in business development that you've worked so tirelessly to attract to your company, and that may have come with stock options and equity. These are all things that we're here to support, and I'm sure everyone on the call is willing to have a conversation with you to help navigate. Then we get into sort of the numbers. So we bucketed the questions around debt and then equity separately. So of the 200 companies, there was a projected 432 million in debt projected. The median was 200,000, with the average around 2.8 million. That figure has been updated. Now, interestingly enough, in the first pass of the numbers last week, before we had consolidated across Canada, it looked like debt was going to increase quite significantly, but it seems that has actually been sort of pared back, and we're making assumptions that might be because companies are being a little bit more conservative. You don't want to take on too much debt. A, it doesn't look great when you do go around for an equity raise if you have debt to pay back. B, do you need that much capacity right now given the certain environment? So there's a little bit more conservative mentality around that. The median still 200,000, but the average reduced about 800,000 for some of the larger companies, one could assume. The equity side, I was actually surprised to see, I think this actually looks healthier than initially thought. I think the revenue is where it shows that we've taken the most, you know, impact. Hate to use that word because we all look at impact as a positive word in clean tech. But the projected raises were predicted to be around 2.05 billion, the median at 2 million, and the average around 11.474. Updated raise is now about 1.6 billion across those 200 companies. The median about 700. So that median between the 2 million to the 700 is where we're seeing the most impact. And then of course the average around 10 million, a nice round number. So thank you for that. In terms of the survey results, so have you lost equity to date? Yes, about 300, it looks to be about 300 million across 200 companies has been lost as an opportunity to help propel the sector forward. And of course, these numbers are what we're sharing with different levels of government to talk about recovery packages and things like that. We always ask if the government has done enough. In our first survey, where we focused more on the qualitative conversations, it was actually a much lower yes number. And now we're seeing that 17% do think the government's doing enough. One of the things that we're balancing as an organization, and I'm happy to hear your thoughts through text or comments. The government definitely plays a role in this recovery and sustaining the sector. On the flip side, I think we need to lean on industry and investors as they look to recover in the coming months as well, that they're balancing out the work that the government's trying to do with the work that we can all do as an ecosystem more broadly. And it's we are on the phone with many of them asking how can they modify programs so that more and more companies like you can fit in. And so it's an ongoing discussion, and being candid and direct is really important, and hopefully we can continue that in the coming days and weeks. One of the sort of questions we asked, we heard a lot that people wanted sort of one-time grants, and I actually presented this information to a few folks this morning. And 66% asked for grants over 100,000. So let's say that could be up to 250,000. And the rest are so small. And one of my comments was, this should show you how modest and lean some of these startups are operating when they're asking for under $100,000 to keep the lights on for the next 3 to 4 months. If a recovery package of 20 million, it almost seems not laughable, but it's something that I think we want to make sure we really think this through and understand, what do companies really need to survive and thrive, post-pandemic. But I thought this is a really interesting, topic for conversation. We're just not used to getting those big billions of dollars into the sector like some of the other sectors get. And then just some more commentary, and these comments will be more fleshed out next week. But some just early indicators, a lot of priorities around, salaries, maintaining salaries for your key, people, technology development. There was actually quite a bit of commentary on making sure that municipalities and other larger other keystone projects have an opportunity to get capital put into them, because a lot of those projects are based on the transition to a greener operations or a green economy. And so I thought that was interesting to highlight. And then of course, with universities and government facilities closed, a lot of the earlier stage companies really rely on that knowledge and power to support their technology developments. And so with that being delayed and stalled, there's a little bit of waiting that the companies have to go through. Now just going to do a quick, I know this has come up quite a bit, we'll shift our mentality. Those are the results of the survey so far. A report is being put together. If anyone has any other comments or things, please feel free to ping me directly. But we'll shift sort of our mindset now to what has been done since our call last week. The BDC did launch their matching fund program. It is called the Capital Bridge Financing Program. It's a convertible note structure to match, a VC's commitment to the company as well. So you have to have both at the table. One of the prerequisites is that you do need to have raised 500,000 in capital before applying for the program. And I know 50% of you are on here saying, okay, I haven't done that. I'm also keen to know about the companies that have bootstrapped successfully over the last while. We see a lot of really fascinating companies that have bootstrapped, and they're 2 to 3, 5 million in revenue, so they wouldn't meet this prerequisite. But now's the time where they need, they want to look at equity to beef up their capital for cash flows. And then of course any matching investment is subject to the usual due diligence review and terms for BDC. If this is of interest, it's important that we get you through your VC as well as the local BDC reps. So each region has one, each province has one, but the program is ideal for high potential companies who have already syndicated an investment, and it's not just limited to existing BDC clients. So I think that's good. I see a few comments here. I'll jump in after and respond to that. Also wanted to clarify, and we keep getting more and more information on this, these three programs which seem to have the most impact on clean tech companies. The wage subsidy, that model has been reworked, and I actually wasn't crystal clear on what they were trying to, how they modified it, but now I think I'm clear. But basically, instead of having to go back and look at last year, March over March, April over April, you can look at, you know, revenue from, you know, January and February. And if you show a decline in March, April, May, and so on by 15% or more, then you are eligible for the wage subsidy. So that's quite a shift. Originally it was 30%, now it's down to 15. And of course, you know, some companies were pre-revenue. And so that'll be something we know that this is still an issue for many of the earlier stage startups that aren't even in revenue yet, that maybe have purchase orders, letters of intent for revenue in the coming months. So we continue to push that agenda and message to the right folks, and we'll continue to do so on your behalf and with you, in partnership with you. They also brought in the work sharing program to include product development and technical employees. That was originally not the case, but that clarification and has been made, and the policy has been updated. And then of course, we've heard from quite a few folks that, you know, you want one of the greatest tools that many of you could leverage, being pre-revenue, is your SR&ED tax credits. And the government has acknowledged that there was a huge backlog, and they know it's a problem, and they are committed to working through that and getting the cash flow to you as soon as possible. And we should have more updates on that again next week, but we know it's something that's top priority, understanding that you're the most impacted by this issue. And just the standard regular slide, you know, we are here to support, you know, Foresight, all the EIRs, all of the other networks across Canada. If you need help, please reach out and we'll make sure we connect you to the right folks. If we can't help you ourselves, if you have stories to share, I think in previous presentations, week by week, you've seen we've had a lot of information about the manufacturing group that's come together. About 40 to 50, you know, companies have pivoted in the short term to manufacture, you know, health products and needs that are responding to COVID-19. And we're obviously sharing all of that as well. So reach out if you want to share your story, or if you need help connecting and getting more information and tied into those networks. We are going to continue to hold these sessions. It'll be a little bit of updates on surveys and programming, but on the flip side, we also every week tend to have speakers to talk about, okay, what's happening in industry, what's happening with investment, and what's happening with government to support, you know, the clean tech ecosystem through this unprecedented time. And then, of course, again, we've launched some new investor profiles on our website as well, so that if you're looking to reframe how you present your business and make sure that you're ready for when this does recover, you know, this will recover. It's going to be, again, up to us to see how quickly we can make that happen and how we can support. But, you know, we're here with you and hopefully help transition, you know, faster. So maybe we can open it up. There's been a few questions. Keith, do you want to banter with Tom a little bit about some of these questions that have come through?
Good question. I was popping a few comments in. So Tom, if there's anything specific you want to chime in as well. There has been a thread about the wage subsidy not applying to pre-revenue companies, and the article in Medium about how, you know, startups will fail. And I'm only going to make a comment, and this is a comment out of solidarity, but also reality. And so the comment that I make is, this is my third recession as a leader of a business. And interestingly enough, both of the first two recessions I went through, my companies were not in revenue yet. And what I will tell you is that, and for some of the older guys in the call, all of these like wage subsidies and like grants and stuff, none of that stuff came up in the last 2 recessions. Like it did not exist at all. And so from the reason I'm sharing that with you is because, yeah, it's certainly frustrating when you see other people taking advantage of certain things that you can't. But my encouragement to you is, first, the spectrum is not succeed or fail. The spectrum is actually succeed, pause, or fail. Because for some of us, yeah, we have to like say to ourselves, like, I need to generate income so I can pay for my mortgage in Vancouver or some other part of Canada. And I get that. And so my encouragement to you is first, ask the honest question, like, where are you as a team and as a person around that? And then the second one is, you know, we started this thing talking about investors. Like, at the end of the day, we're looking for people who will take this situation and turn it into progress. And so I feel for you. I've been through it twice. This hairline is the past 2 recessions, right? And all joking aside, like, you know, you will find ways to create opportunities for funding, which starts at revenue, and sometimes it's pre-revenue and sometimes it's consulting. And, you know, I know a co-working space in Langley that has been doing food delivery, right? It's like, we find a way. And so my encouragement to you is, if you're frustrated about the 75% wage subsidy, here's my encouragement to you. And I say this in all seriousness: take a piece of paper and put wage subsidies suck, right? Write it on a piece of paper. And then at the end of the day, what I would do is, with a good bottle of wine or a beer, burn it. Burn the piece of paper on your deck, burn it in your backyard, and let it go. And then wake up tomorrow and say, now, how am I going to generate revenue and make progress? And my comment to you is, if you don't know the answer to that question, ask, right? The Foresight team is clean tech focused through and through. They will help you to kind of navigate this process. If you want to reach out to me, you want to reach out to Tom, I'm sure, like, there's lots of us who want to help. But my comment to you is, don't dwell where you can't control it, right? If they don't have the wage subsidies, at the end of the day, grieve it, burn it, let it go, move on. Because that, like, we don't have time to lobby, you know, for certain things. Like, you know, Foresight has already done a phenomenal job of impacting where they can, but at certain points in time, we can't. So I don't want to belabor it. We are in this together. I will gladly help in any way. If you guys need 30 minutes to brainstorm, I'll gladly do it. But let's find ways to move it forward, even if the government can't support us. So Tom, over to you.
Yeah, well, that's a great summary. I totally agree with everything Keith just said. The only thing I'd say is maybe don't use a good bottle of wine, because if you're being capital efficient, you probably want to look for a bargain bottle. But maybe a beer. Yeah, I mean, sure, the 75% wage subsidy, it's not there for pre-revenue. There are, I mean, the Canada Energy Emergency Business Account, the 40% loan, the 40% interest-free loan. I mean, it's a $40,000 loan, $40,000 loan, interest-free. If you pay it back by the end of 2020.
2022.
Sorry, 2022.
Yeah, it's unbelievable.
$10,000 of that loan is forgiven. So, you know, $10,000 of free money if you can pay the loan back by the end of 2022, and then 5% interest after that. So, I mean, that's available. There are some other things available, but really, like Keith said, I mean, it's these things weren't available in other recessions. And what do founders have to do? They just have to figure out ways to, if you are a revenue company, protect your revenue or keep it close to where it is, or even find ways to increase it, and find ways to keep your costs under control, just like in any other times.
Yeah, no, I think that's great. And I know Keith made a note here. You can get the loan approved pretty quickly, within 5 days. There's also a question here about whether or not, there's a question here about if all resources have pivoted 100% to COVID. And the feedback we've gotten so far from different government partners is that no, that's not the case. You know, and I know it feels that way right now because of the health crisis is front and center. But there is hope that all the existing tools and mechanisms for clean tech and other sectors as well, health tech, you know, they still maintain. Great. We are at 12:55, so I think we'll close it off. A strong hour today. Great group of people. We had over 100 folks online at one time. I just wanted to thank everyone again for listening in. We will share a copy of the presentation and the recording with everyone if you need it. And next week we'll have some more updates on quite a few pieces as well, a couple of new speakers. And thank you, Tom and Keith, very much appreciated, and look forward to working with everyone to continue to push our needs and our voice ahead. Thank you. Okay. Bye, everyone. Hey, thanks, Tom. Really appreciate it.